Workday just deployed $1.6 billion for share repurchases in a single quarter, yet their liquidity is suddenly flashing warning signs. Is this aggressive financial engineering hiding a deeper trap, or just a temporary capital mismatch that the market consensus misunderstands? Look closely at the last quarter subscription revenue of $2.35 billion to start unraveling this mystery. This represents a solid 14.3% year-over-year subscription revenue growth, which naturally catches the eye of growth investors. Analysts focus on this top-line acceleration, assuming Workday effortlessly dominates the enterprise software sector. They have a massive safety net because the total subscription revenue backlog of $27.29 billion acts as a giant cushion. This backlog means they hold guaranteed future contracts for essential enterprise software like human resources databases. But despite this massive backlog, management issued a forward full-year subscription revenue guidance of just 12 to 13%. This deceleration proves that premium cloud platforms are not immune to macroeconomic gravity. To grasp why Workday grows while others stall, look at how they monetize artificial intelligence. The customer base now exceeds 80 million users under contract, giving them an incredible data advantage. Leveraging this footprint, the company facilitated over 14 million hiring processes using their new recruiting agent in just one quarter. Casual observers assume tech companies simply add AI buzzwords to brochures, but Workday is embedding agentic AI into their core platform. Instead of a basic chatbot, they are building software agents that execute actual tasks like automatically processing payroll corrections. By delivering real automation, they justify premium pricing, supporting their massive 76.2% gross margin. Gross margin is simply the profit left after paying the direct costs of delivering the software. This brings us to the elephant in the room, which is how this immense pricing power translates into cold cash. Look at the free cash flow of $616 million, representing a massive 46.3% year-over-year free cash flow increase. Headlines scream about the reported GAAP net income of $222 million, but accounting profits do not always pay the bills. This exceptional cash conversion is the fundamental strength of the business, proving you must always check if cash flow is higher than stated net income. If the cash machine is powerful, why is the company actively bleeding liquidity? To understand this, we must look at the silent killer of shareholder value, which became obvious when Workday recorded a share-based compensation expense of $409 million. Share-based compensation is the practice of paying employees in company stock instead of cash, severely diluting ownership. Wall Street is captivated by the non-GAAP operating margin of 31.8%, stripping out this stock-based pay to make the business look highly profitable. But that $409 million represents a staggering 16% of total quarterly revenue, meaning Workday heavily subsidizes its profitability through massive equity stock grants. This reliance on equity compensation artificially inflates adjusted margins, and you must remember that stock-based compensation is a real economic cost. How does management hide this relentless dilution from the everyday investor? They buy the stock back at a steep price, which is exactly why Workday executed a share repurchase program of $1.6 billion in a single quarter. Many investors see buybacks and automatically assume management is confidently returning excess capital to shareholders. But this capital outflow rapidly drained overall cash reserves to $4.353 billion. This is down significantly from the prior cash reserves of $5.443 billion reported just 3 months ago. Workday is not buying back stock from a position of excess strength, but rather doing it to absorb millions of new shares printed for employee compensation. You simply cannot burn through over $1 billion a quarter just to tread water on your share count. This aggressive cash drain becomes genuinely concerning when evaluating the structural integrity of the balance sheet. This capital allocation occurred exactly as $998 million in long-term debt was suddenly reclassified as a current debt liability. Suddenly, Workday has a $1 billion maturity coming due within the next 12 months. Because of this sudden shift, the company's current ratio plummeted to 1, down from a healthy current ratio of 1.32 in just one quarter. A current ratio measures a company's ability to pay its short-term obligations, and anything near one means current assets barely cover current liabilities. Most financial commentators completely ignore this declining liquidity ratio because Workday is widely considered a resilient tech darling. But draining $1.6 billion in cash for stock buybacks right when a massive debt payment approaches is a highly dangerous game. If the global macroeconomic environment forces higher refinancing rates, this stretched capital structure could severely restrict their financial flexibility. Buying back stock when you have $1 billion due is a lot like remodeling your kitchen while your mortgage is in default. Is this aggressive financial engineering actually hiding a deeper structural trap? The answer lies in the intense tension between their phenomenal operating business and their increasingly strained capital allocation strategy. On the operating side, Workday is an absolute powerhouse, evidenced by their 14.3% subscription revenue growth. This growth and exceptional cash flow generation prove their core enterprise software business remains highly resilient despite industry headwinds. They are successfully selling productivity-enhancing artificial intelligence, which is actively protecting their market share against relentless legacy competitors. But financially, Workday is walking a very tight rope that leaves little room for operational error. Management's reliance on paying employees with stock has forced them into an unsustainable corner that aggressively drains liquidity. They are burning through cash reserves simply to hide dilution, all while a $998 million current debt liability stares them down. The current ratio of 1 is a flashing yellow light that both retail and institutional investors absolutely cannot afford to ignore. So, what is the ultimate investor takeaway for your value investing journey? Workday is definitely not a value trap, but it does require careful monitoring of its liquidity, given that $998 million impending debt maturity. The massive subscription revenue backlog of $27.29 billion provides an incredibly wide economic moat, ensuring high visibility for future revenues. The underlying cash generation is very real and robust, forming a solid floor for the company's intrinsic value. However, for this stock to truly be a safe compounding machine, management must dramatically decelerate their aggressive share buybacks. They need to let that operating cash flow rebuild the balance sheet to comfortably handle upcoming debt obligations without requiring expensive refinancing. If you apply fundamental analysis to Workday, do not just look at the shiny artificial intelligence headlines highlighting their 80 million users. Watch the cash reserves and the share count, because a great software product only creates lasting wealth if the financial foundation underneath it remains solid. This is exactly why a sound investing strategy requires looking beyond the surface, as sound stock market analysis uncovers the truth hidden in the balance sheet. I have walked you through the numbers, the underlying strategy, and the very real risks facing this enterprise software giant today. Do you think Workday's massive cash flow is enough to safely absorb their looming debt, or is their stock compensation strategy a ticking time bomb for shareholders? So let me know in the comments. So hit subscribe so you won't miss what's next, and jump straight to the next video, because that could be the very insight you need to get ahead.